This year's gone by quickly, with the tax deadline postponed until October. The usual signs to get moving have vanished. The first 3 months of 23 have been interesting. Overall industrial activity has decreased compared to the first quarter of 22, as well as compared to the last half of 22 due to interest rate hikes, inflationary pressures, and global turmoil leading to uncertainty. So, what should we be watching for in the last 3 quarters of 23? Well, the Fed Reserve is in a difficult position. On one hand, inflation has been stubborn primarily due to consumer spending, the cost of shelter and services. On the other hand, if the Fed increases interest rates too quickly, it risks causing banking failures, which we've already seen. A pause in rate hikes could indicate that the Fed is concerned about breaking something else, which could further shake confidence. 2 weeks ago, many were expecting a 50 basis point bump, but now it is more than likely we will and we did see a 25 basis point increase, which would bring the Fed funds rate to 4.83. In January last year, it was 0.58. It's unlikely that we'll reach the anticipated 6% target this year, but with the fluidity of events over the past week, it wouldn't be surprising. Class A industrial leasing activities delivering more inventory than ever before, fueled by a low cost of money, large global manufacturers selling their aging campuses, and developer appetites with an institutional credit card and desire for returns. Name brands such as Kimberly-Clark, Boeing, Beckman, Kraft, Heinz, National Oilwell Varco, Schneider Foods, Ricoh, and others have hit the exit ramp, resulting in an array of beautiful new logistics spaces with all the new amenities of upgraded warehouse fire suppression, super high stacking capabilities, and marvelous truck maneuvering. Just over 2.7 million square feet of new addresses are open for business and seeking residents. Goodman's development in Fullerton and the old Kimberly-Clark site has been noteworthy, delivering first an otherwise crowded waiting room with size ranges not normally found in North Orange County. 100% of the 1.6 million square feet have been leased to recognized names such as Sprouts, Samsung, and Bandai. It has been very successful. What remains are a number of buildings that are essentially the same size range, 120 to 200,000 square feet. It is likely that we'll see some lease rate softening in order to get all the buildings absorbed. Office building defaults are becoming a concern. The hybrid working environment has decreased high-rise occupancy. Office deals are expensive to originate, and once downtimes, rent concessions, beneficial occupancy, tenant improvements, and broker commission bonuses are computed, roughly half the owner's income will be pre-spent. Orange County's stock of office buildings is aging, and many don't provide the modern experience that many office tenants are seeking. Retrofitting these vintage spaces is extremely expensive and does not guarantee a higher level of occupancy or higher rent. Finally, we're in unfavorable interest rate environments and lenders are unwilling to loan on office space. Some owners may opt to hand over their keys to the lender rather than investing a ton of money to bolster leasing activity. Now, if you're in need of an experienced commercial real estate broker, I can be reached at 281-222-0433. I appreciate your time for watching. Hope you have a great week.